Howdy, Jacob here. Today we're looking at Cars.com in the interactive media and services industry. They're an audience driven tech company that provides solutions for the automotive industry in the US. Cars commerce platform connects, so interactive media and services, I guess it's more of an e commerce company. Founded in 1998. Growth is not astronomical, but you are looking at low to mid single digits on the revenue growth. You're looking at a gross margin of very high percentage, 82%, but big hit on operating margin. They have been as high as 30%, but have recently been upper single digits. However, the most recent year in the upper single digits, they're still looking at a ROIC of 13%, so still very solid. Income statement shows good amount of, well, not a huge amount, but decent payments of R&D. It looks like they're finding ways to reinvest back into themselves for future growth. And it is about half of their net income. So good spending there, good amount of spending there. Balance sheet shows not a lot of cash on hand with a good amount of debt. So they have enough cash for their short-term debt. We're not terribly concerned about that. But this $460 million, I want to see what that is in relation to the free cash flow. Okay, so not sure why this is going to be their capex over here and then over here. So pretty low capex, honestly. Production of free cash flow of a little over 100 million, $100 million. So it is less than 5 years of their free cash flow for long-term debt. But again, we don't know right now whether, if it's due in 2 years or 10 years, whatever it may be. We do know the use of cash, though, is share repurchases and acquisitions. We are going to have to incorporate a little debt reduction into our assumptions because they're going to have to pay down a little bit of that debt, being as it is over 4 times the 5-year average free cash flow. So starting with our assumptions on the revenue growth side, I'll probably stick with maybe a little bit more in inflation, saying that they make acquisitions that are hopefully advantageous. Otherwise, they just get growth from inflation. On the margin side, I'll probably stick with the free cash flow, but do a pretty large range here, maybe 16 and 19%. On the share change side, 1% is about 12 million to offset stock-based compensation, 42 million. That is going to be a decent amount of their free cash flow. So maybe we'll do 0.5%, 40%, 30 to 40% of free cash flow going towards that. I'm comfortable with. And then 30 to 40% to acquisitions to get these type of margins, this type of revenue growth. And then I think that leaves about 20 to 30% again I guess I said 30 to 40. So now 20 to 30% to reduce debt. And I think I'm good with that. And again, you have to balance what they've done historically with what you want them to do. So having 4 times their 5-year average free cash flow in debt, if they reduce it 20% over the next couple of years, increase free cash flow along with that, it could turn into a 2.5 times, which is a very comfortable level. I think if you're producing free cash flow, almost any lender is going to be comfortable lending to you. And even at 4 times, the lenders are going to be fine. Lenders love to be risky as heck. But for me as an investor, I don't want the company to be risky as heck. And so for me, I'm pretty comfortable with these assumptions. And we're really not saying it's too far off. I think the only thing, I'm going to drop this enterprise value. I think that we're still going to be looking at a 10 to 20% higher enterprise value than market cap at the end of this period. And I think the growth is below market still. So even still, 39% drop before you get the return we're looking for here. I think I'm just gonna wait until it gets to a more attractive price, research other companies in the meantime, but honestly, not terribly far off. But I would want to understand this difference when I do look into this company. Why is free cash flow so much greater than earnings? And it looks like it's not due to stock-based compensation, but depreciation and amortization is pretty huge and more than offsetting their tiny capex. So it looks like that's literally what it is, but you want to better understand that. Anyways, I hope you enjoy the video and have a great rest of your day.